Hello there, dividend growth stock investors out there. Colby, the DGI Crab, coming to you here on a Monday, and I thought that this would be sort of a fun one to give a try to. This is what I call the Dave Ramsey 4 ETF portfolio, and this is not Dave approved, just Dave inspired. So I have been a fan of Dave Ramsey for quite a long time. Back when I was paying off student loans and a car and a credit card, I was definitely 100% committed to Dave Ramsey and his plan of financial health and what is his financial peace. I've never done like one of his financial peace university courses or anything like that, but definitely am a fan of him and his YouTube channel and his strategies. So I thought it would be interesting to take a dividend growth stock perspective on Dave Ramsey and just see what a Dave inspired portfolio might look like. What do you think about it, Dave? I think this is probably the stupidest video that you've done yet, DGI Crab. I do not approve of investing in this way. All right, fair enough. But maybe you'll like it once we get a little bit further into it. So, I'm not a licensed professional financial advisor, so the opinions expressed in this video are just this one crab's opinion, and you should always do your own due diligence before investing in any stock or ETF. So for any of you out there who don't know who this guy is, who is Dave Ramsey and what does he preach? Well, Dave preaches getting out of debt and being financially free by using the 6 baby steps, which are number one, save $1,000 for a starter emergency fund. Step two, pay off all non-mortgage debt. Step three, increase emergency fund to 3 to 6 months of expenses. Four, save 15% of household income into retirement funds like a 401k and or a Roth IRA. Five, save up some money for your kids' college if you have kids. And six, pay off your home mortgage to become 100% debt free. And steps four, five, and six are meant to be done concurrently at the same time. So the thing I like about the Dave Ramsey baby steps plan here is that of all of the financial advice and all of the experts out there that all have their own plans and their own strategies and this, that, and the other, of all of them, this is the only one that I believe is 100% guaranteed to work. So if you follow these steps religiously, then you will eventually become well off, let's just say financially. It's not get rich quick, it's get rich slow, but there is no doubt whatsoever that if you do all of these things in the right order, right down to the letter, you're going to be so much better off even just a few years from now as you are right now today. So I'm what would be referred to as on his channel as Dave Ramsey-ish. I've certainly done some of this. I've not done it all right exactly to the letter of how he describes, but I definitely tip my cap to Dave Ramsey for opening my eyes to just how corrosive and awful debt is and how much it restricts you from being able to live your life freely and make the choices that you want to make, not just with investing, but with your career and with all kinds of different things. If you've just got this this weight on your shoulders of all kinds of just bad consumer debt. So I hope that all of you get out of consumer debt before you start investing any serious money into the markets, because honestly, with most of the consumer debt, especially things like car loans and credit cards and things of that nature, you're going to get a guaranteed rate of return on that, which is just not having to pay the interest rate on those things anymore. And a lot of the times you'll do better with that rate of return than you would in the markets anyway. So what Dave does and does not do in the stock market, according to him. So Dave does not invest in single stocks. That's right, DGI Crab. See, you're crazy. Single stocks carry a lot of risk, and I'm not all about risk here. Nobody beats the market. Yeah, right. Fair enough. I can get down with that, Dave. I like to invest in single stocks, but I'm a nerd and I like to pay attention to that kind of stuff. Dave owns much more real estate than stock. That's right, and I paid cash. Yeah, he paid cash for all of his real estate after going bankrupt in the late '80s. Not easy to do, but you get enough income rolling and enough cash flow coming in, and that could be a real possibility for you. Dave does not own ETFs, which is what this video is about. Dave recommends investing an equal amount of money into four types of mutual funds. And what are those again, Dave? Well, I recommend investing in four types of mutual funds: growth and income, aggressive growth, and international. So an equal weighting, an equal amount, 25% each into all four of those. That's correct. All right. So in my opinion, what would a Ramsey 4 ETF portfolio look like? Well, I don't invest in ETFs. You'd be too tempted to buy and sell and trade those like you would individual stocks. Mutual funds are easier to hold. Well, I'm a buy and hold investor. So if I only wanted to invest in four ETFs and not do any individual single stocks, what would my strategy look like to stick as close to what you do as possible, Dave? Well, I think I would probably do 25% to VOO or just an S&P 500 fund, which is what VOO is. That's the one that I do personally. And that would cover me for the growth aspect. 25% to DGRO, which is the iShares Dividend Appreciation Fund. And I think this would be a good option for the growth and income section. 25% to SCHG. This is U.S. large cap growth. This would cover aggressive growth. It does not pay, well, it does pay a dividend. It just doesn't pay much of one. The share price appreciation is definitely the thing we're looking for on this aggressive growth. And then 25% to any of my regular viewers, you probably know by now that VYMI, Vanguard's International High Dividend ETF, is my favorite international non-US stocks ETF out there right now. And I will tell you, I keep looking at other alternatives because there's more and more of them out there every day, and VYMI continues to be my absolute favorite. Now, I only do 5% into the international market there. But if we're sticking to the Dave Ramsey strategy here, we're going to do a 25% allocation even into the non-US stocks. So what would the theoretical performance of this 4 ETF portfolio look like? Well, let's see. You've got a price appreciation rate of VOO at about 12% on average, 11% to DGRO, 16% for SCHG. It's just amazing that SCHG since inception continues to just be a monster and a price appreciate by 16%. What an absolute beast that is. And then VYMI, so far about 8% on average there. The dividend yield that we're getting right now, based on today's recording, about a 1.3% yield from VOO with a 7% annual dividend growth rate. DGRO, about 2.3% on the yield with a 9% dividend growth rate. SCHG, we're getting less than 0.5% in dividend yield, only about 0.4%, and a dividend growth rate about 4% a year. So that is just not a fund that's focused on dividend payouts or growth. It does pay us a little something, but again, that one's price appreciation. And then VYMI, about a 4.5% dividend yield, and I'll just go kind of conservatively here and say that that's probably about a 4% dividend growth rate as well. And then we've got our averages down here at the bottom. So I think we're looking at, we'll just say between 11.5% and 12% on the price appreciation. Doesn't quite beat the S&P 500, but we are getting a better starting yield overall while getting about the same amount of price appreciation as if we were just doing S&P 500. And then our dividend growth rate was going to average about 6%, but that's about in the neighborhood of the S&P 500. It's pretty close. So I think this strategy overall doesn't look too bad, if I'm being perfectly honest with you. We're getting an overall growth rate that just about equals the S&P 500 growth rate. We're getting a bit better diversification because we're getting exposure to international stocks. And then we're zeroing in on some of the quality companies for growth as well as for dividend growth with DGRO and SCHG. And that overall is giving us a starting dividend yield of not quite double the S&P 500 yield, but definitely more than 1.5 times as well. So not bad, not bad. This is definitely not something that that looks like a terrible strategy, if you ask me. So Dave himself would not approve of doing any of this stuff in a brokerage account unless you are 100% debt free, including having your house paid off. Isn't that right, Dave? Yes, you should be 100% debt free before you start messing around with any of this stuff. A lot of you need to get off of your assumptions and go out of your mother's basement, get yourself out of debt, and do something that works and has worked for tens of millions of people out there. All right, well, fair enough. DGI Crab here has not impacted the lives of 10 million plus people the way that you have, Dave. So I will definitely defer my level of expertise over to yours. And while I'm not 100% a Dave Ramsey baby steps person, I'm a bit ish as far as that goes. This is definitely a strategy. The baby step strategy is 100% guaranteed to work as far as I'm concerned. And I think that this 4 ETF portfolio certainly doesn't look bad. I can't argue with the numbers after I put them together and ran them. Looks pretty good to me. I'm going to keep investing into single stocks in addition to ETFs because I enjoy it. I think I'm pretty good at it. Hopefully, once I build up some history on this channel, we'll be able to see some proof in that as the further that we get along here. But that's our Dave Ramsey inspired but not approved 4 dividend ETF portfolio. Let me know what you all think. Do you like Dave? Do you not like Dave? And what do you think about this 4 ETF portfolio? Does it make sense to you? I'd certainly like to know. Links down in the description to this video below to the 4 tiers of dividend growth stocks that I have selected for the channel and a rundown of why they made the cut, as well as links to doing a similar strategy with ETFs only. If you don't like this strategy, maybe you could check out that one. Hit those good YouTube buttons to support the channel. You know what they are already. And remember, everybody, when it comes to dividend growth stock investing, patience and perseverance accomplish all things. Well, that's probably the smartest thing that you've said in the whole history of this freaking channel. Oh, thanks, Dave. I appreciate that very much. Until next time, dividend growth investors, my name is Colby, the DGI Crab. Email me your questions at dgicrab@yahoo.com, and I'll catch you on the next one.